This is how we calculate the numbers to make sure that your mortgage is going to get an approval before we even submit to the bank. This is Camilo Rodriguez with Mortgages Lab, and I'm going to show you how to do the numbers for a pre-approval or for a purchase for any property, first-time home buyer, or anybody that like to buy a property right away. So we have here the client's name, Speedy Gonzalez in this case. We have what we think the credit history is going to be, and their income, 95,000 in this example. And we have the spouse, which is Minnie Mouse, and the income is 75,000. Here we have an estimated of the property that they want to purchase. For example, we estimate that the taxes are going to be 150 a month, that the heating is 110, and if this is a townhome or a condo, we have half of the condo fees because this is the policy of what the banks are looking for. Okay, so we just add for this into this section. And now here we add any liabilities that the person may have. They may have Visas, MasterCards, car loans. In this case, in this example, we have a person with a 40,000 car loan and a payment of 450 a month. Okay, and then we go into these scenarios. We can run several scenarios for you to make sure that you have different payments and different options for you and we do this, and this would work with several lenders, so we know that we have a plan A or plan B depending on your situation. In this case, let's say that the person or the family would like to purchase a home for 750 with 10% down, which is 75,000. We will have here the mortgage requested, and here the CMHC fee, and we can get into details why you need to pay the CMHC fee, which is for 25 years. And the total premium will be $20,925, which means that your total mortgage is $695,925. We have a term of 5 years, amortized over 25 years. Let's say initially for the pre-approval, we have an interest rate of 4.9 fixed rate. This would be the stress test rate, and we can later explain how that works, or in the discovery call where we do these numbers, we'll explain you how this works, and you'll have a payment of $4,008.01. Okay, and over here we'll talk about what other expenses are there in order to purchase the home. For example, if there's any property transfer tax, depending on your province, if there's any legals or title insurance, any appraisals required. In this case, the appraisal is zero because the down payment is less than 20%, and I can explain later why. You have property insurance, any tax adjustments. So we know in this example that there will be an additional $3,000 on top of the down payment. So you make sure that everything is accounted for. And now we get to the meat of this small example. And that is, if we look at this number, gross debt service, it's a fancy name for the percentage of your income used for home payments. According to the bank calculation, you're using about 37.35% of your annual income for your home calculation. And this is the TDS, total debt service, which is what percentage of your income you're using to make the payments on this home plus any other debts. In this case, it is the car loan. In this example, this should be under 39%. This is according to these beacons, and this should be under 44% according to major lenders, which means that if we have the documentation ready and we have vetted the documentation and everything checks well, the bank should approve this loan with a high degree of certainty. LTV means loan to value, which means how much down payment you put in down, which is 10%, which means that you have 90% financing. Again, this is just a very short explanation. If you would like our team to do any of these scenarios for you, feel free to call us at any time, and we'll book a time to do this for you. All the best.